So when you're talking about the difference between a whole life policy and a term policy, it's actually a permanent policy and a term policy. It's incorrectly quoted as whole life and term, where it should be permanent and term. So whole life is the original type of permanent policy. Permanent just means it doesn't expire and you actually own it. Term means it does expire and you're only renting it. Sense? And so you have to think about as far as owning a home, and I compare life insurance to real estate a lot. As far as owning a home, when you own a home and that home can appreciate in value, you get equity in that home. Same thing when you own a life insurance policy, a permanent policy, it can accrue cash value. So you'll have some people that use that cash value to get the equity, the same way you buy a real estate property. I know I'm going to buy this property at a cheaper rate and it's going to appreciate later on in life. I may sell it, I may refinance it, I may use it for retirement planning, whatever the case may be. Same thing, people can use a permanent policy that way. So, Damien, to your question, you know, they may have an additional policy that they're using for retirement supplement. They may have an additional policy that they're using to fund the college for their families or loved ones, right? Their children's. They may have a policy that's solely for legacy. I don't plan on touching any of that money there. I just want to make sure that I want to leave as much tax-free money as possible in my legacy. So now, once you get past those first two types of policies, it's really based on your goals, what you're trying to accomplish. I may have a term policy, one set aside just to pay off my house. I may have another term policy that if I have young children, you know, especially in cases of blended families, if I have young children, I have a separate policy that just goes to, you know, let's say the parent of your young child, right? Let's say you're married, but you have children outside of marriage and they're still young. You may say, I have a policy that goes to the parent of my young child that I'm not married to. Because if something happens to me, I don't want to mix that money. Can you imagine the drama?
I think you're talking about my side children.
You know?
I know. I was like, oh, I should know about my kids on the side.
You know? So Zion need about 4 of those, basically. That's what you're saying. Oh man.
Siedah, also, could you mention to some people, because I realize some people get this late, it matters when you get it, the age you are also, that you get life insurance. I recently spoke to somebody who's, you know, about to hit 70 with a bad heart. And they're like, I want to get insurance. And obviously, you know, they're running into a lot of problems, pre-existing conditions. So if you can speak on that, just for those that don't know why it's important to kind of forego the Louis Vuitton belt at 20 and maybe go ahead and invest in the future.
Yeah, you know, life insurance, the cost of insurance is based on your age, your health, your risk factors, your family history. And so most wealthy people get a policy for their kids as young as 15 days old.
Wow.
Right? When you're 15 days old and you have a social security number, you can actually get a policy. That's because it's the cheapest it's ever going to be. They're healthy for the most part, no conditions. They haven't done anything reckless or crazy.
And they don't put no bills in their kids' name, no light bills or nothing at 15 days old? Okay.
They put life insurance policies in there.
Got you. Okay. Got you.
And so that's what happens. But for a lot of us, like you mentioned, you know, we find out about this later on in life. And so by then, life has happened, right? We might have gained a little weight, back hurt, heart issues, concerns. You know, maybe we got in trouble with the law. There's just some things that when we learn about this stuff, it's too late. And so we have to start educating, which is why I really commend you guys for having this platform and, you know, talking about topics like this, because the more people learn it, the more they understand it. Now we get more people doing it sooner, doing it faster, right? And a lot of times we fall into what I call the term trap. And what I mean by that is we'll say, like, I have insurance at my job. That's one of the biggest things I hear. I have insurance at my job. But when you have insurance through your employer, you don't own that insurance. Your employer owns that insurance. That's called group insurance. So once you leave, whether they asked you to leave, you leave on your own, or you retire, you can't take that with you. So if you work somewhere for 30, 40 years, going off of your employer's insurance. Now, when you retire at 65, you're trying to get insurance, but you 65, back hurt, knees don't work the same. You done been through some stuff. The cost of insurance is so high, and you're on a fixed income. Now, so you want to have something that you own outside of your employer, but also get the employer insurance too. It's a nice cherry on top. It's a nice to have, right? But don't solely depend on that.